Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from KORU Medical Systems, a company that, based on this filing, seems to be walking a financial tightrope. Hopefully they don't fall. We'll be looking at their recent performance and some interesting choices they're making as they look towards the future. This is a Form 8K report, which is basically a quick update a company gives to its investors about important events. In this case, it's about their latest financial results and what they expect to happen in the coming year. The most recent update is from March of 2025. KORU Medical Systems released a press release, so we'll be looking at the details of that release here in this report. They also held a conference call, which is where company leaders usually talk about the results and answer questions. So let's jump right into how they're doing financially. KORU Medical talks about both their past performance and what they think will happen in the future, which they call financial guidance. They're also using some special financial measurements called non-GAAP financial measures. GAAP is basically a standard set of rules for how companies report their finances. Non-GAAP measures are kind of like looking at the numbers in a different way, a way that the company thinks is more useful for investors. Two of the main non-GAAP numbers they focus on are adjusted EBITDA and adjusted EPS. The company is trying to give investors a clearer picture of their ongoing performance. They also warn that their special numbers might not be the same as what other companies use, so it's important to compare carefully. Adjusted EBITDA is a company's earnings before certain expenses like interest, taxes, depreciation, and amortization, plus a few other things unique to KORU, such as reorganization charges, discontinued product expenses, legal costs, manufacturing improvements, and stock-based compensation. This measurement is used to see how well a business is performing without considering financing or accounting decisions, or one-off unusual costs. KORU uses this to plan and predict future performance and to see if they're meeting their goals. Adjusted EPS, or earnings per share, is a similar idea but focuses on the profit each share of stock represents after taking out those unusual items. The company believes that by adjusting for these items, investors can better understand the company's actual operating results and compare them to other periods. The actual numbers are in an exhibit 99.1, a press release. This is where we get the hard data. Okay, let's look at some key numbers from the press release. Net sales, which is how much money they brought in from selling their products, were $7.4 million. For the fourth quarter of 2024, that's up from $6.9 million in the fourth quarter of 2023. So they sold more in the last 3 months of 2024 than they did in the last 3 months of 2024 than they did in the last 3 months of the year before. Gross profit, which is the money they made after subtracting the cost of making their products, was $3.1 million or 42% of net sales. That's compared to $2.7 million or 39.1% of net sales for the same period last year. This means they're not only selling more, but they're also making a slightly higher profit on each sale. And now let's look at expenses. Selling, general and administrative expenses were $5.8 million compared to $4.5 million for the same period last year. This means they're spending more on things like marketing, salaries, and other general business costs. Net loss, which is the money they lost overall, was $3 million compared to $2 selling more and making a higher profit on each sale. They're still losing money overall and the losses are getting bigger. But remember that adjusted EBITDA we talked about? That was a loss of $1.0 million compared to a loss of $0 still losing money. It looks a little better when you remove those unusual expenses we mentioned earlier. For the whole year, net sales were $28.1 million in the previous year. So overall, they sold more products in 2024 than in 2023. Gross profit for the year was $11.8 million or 41.9% of net sales compared to $10.20 million or 39.4% of net sales for the previous year. Again, they're making a slightly higher profit on each sale. Net loss for the year was $10.5 million compared to $7.8 million for the previous year. So they lost more money overall in 2024 than in 2023. Adjusted EBITDA was a loss of $3.8 million compared to a loss of $3 when you remove those unusual expenses, but they're still losing money. As of the end of 2024, they had $9.4 million in cash and cash equivalents. This is how much money they have on hand to pay their bills and invest in the business. Now let's talk about what they expect to happen in 2025. They expect net sales to be between $31 million and $33 million. That will be an increase from 2024. They also expect their gross profit margin to be between 42% and 44%. That would also be an improvement from 2024. They expect their operating expenses to increase by about $1 million due to investments in sales and marketing and research and development. Finally, they expect to achieve positive adjusted EBITDA in the second half of 2025. This would be a big improvement from the losses they've been reporting. The CEO, Linda Tharby, says that they're pleased with their progress in 2024 and that they're focused on growing their business, improving their profitability, and managing their cash flow. Now, looking at these results more broadly, KORU Medical is in a tough spot. They're selling more and they're making a higher profit on each sale. But they're still losing money overall. They're spending a lot on sales, marketing, and research and development, which they hope will lead to future growth. Their ability to turn things around depends on whether they can continue to grow their sales, improve their profit margins, and control their expenses. The fact that they expect to achieve positive adjusted EBITDA in the second half of 2025 is a good sign, but they'll need to execute their plan effectively to make that happen. It's like they are building a bridge as they are crossing it. Overall, the company has a challenging year ahead. While revenue growth and improved gross margins are positive signs, the increasing net losses and reliance on adjusted metrics raise concerns. Investors should watch closely whether the company can achieve its projected profitability improvements and manage its cash flow effectively, or if they will need to visit the bank for more cash or thanks. For watching, if you enjoyed, please subscribe, like and comment.